Welcome to Chit Chat Stocks. Before we get to this episode, we want to talk about our friends at Public. If you trade options, you've got to ask yourself, why wouldn't you choose an options trading platform that puts investors first? At public.com, there are no commissions or per contract fees. And more importantly, it's the only platform where you can earn a rebate on every single contract traded. That means you can save on your options trading costs and keep more of your capital in play. Whenever you trade options on Public, your savings are automatically applied. So don't change your strategy, change your platform, and see the difference in your bottom line. No commissions, no per contract fees, and it's the only options trading platform where you can earn a rebate on every contract traded. That's public.com. This is paid for by Public Investing. Options are not suitable for all investors, carry significant risk. Full disclosures are in the podcast description.
Welcome to Chit Chat Stocks. On this show, hosts Ryan Henderson and Brett Schaefer analyze businesses and riff on the world of investing. As a quick reminder, Chit Chat Stocks is a CCM Media Group podcast. Anything discussed on Chit Chat Stocks by Ryan, Brett, or any other podcast guest is not formal advice or recommendation. Now please enjoy this episode.
Welcome to Chit Chat Stocks. Today we are joined by first-time guest of the show. He goes by IndraStocks and he's the author of the IndraStocks Substack. And today we are talking about a company, I don't know if we've really ever discussed it on here, maybe once before, but it's one that Brett and I are less familiar with. It's called Cardlytics. And I guess I'll just start with how you found this, because I know it's come down quite a bit from its highs. So I guess what inspired you to start looking at this and take a deeper look?
Sure thing. So I started out as a analyst at a family office a few years ago and slowly transitioned into a more portfolio manager role. And earlier on in the analyst days, it was like 2020, 2021. Cardlytics was obviously booming. I think the stock peaked at 300 something, like multi-billion-dollar market cap, blah, blah, blah. And I think the idea there was pretty good, right? Where this is a company that they sell ads in a bank channel. A bank isn't going to want to partner with a bunch of different ad sellers. So they sort of have a little bit of a monopoly in the bank channel. They had just landed JP Morgan Chase as a partner. So they had JP Morgan Chase, Wells, Bank of America. The story was pretty in the sense that, they had this environment pretty locked down, and there have been quite a few competitors who had tried to enter this space and failed previously. But the stock was, pricing in like pretty substantial growth. So I had come across it in that family office role, just because there's a lot of other smart people that we would interact with that had invested in it and would talk about it. And it started to become a lot more interesting to me as the stock fell in 2022, just because around that time, there's quite a few companies that were going down 80, 90, 95, 99% that year. So it's the story, I think, the underlying thesis, high level, was still relatively intact. There's some hiccups along the way, but it became pretty interesting, I think, at that point.
Okay, so we'll talk about the business overall, get a little more in depth there in a second, but I guess let's give some context around what's happened the last couple of years. So you mentioned it. They soared. I think they hit a peak kind of in 2021 here, and it looks like they've dropped roughly 94% off of its highs. So why has it come down so far? And then I guess part of that might just be because it was so exciting at the time, but I guess what's happened over the last 3 years that's created this, I guess, rough returns?
Yeah. So this is a company that they've been around for quite a while. And as an advertising platform, you get a really big benefit when you're scaling, the number of users that you can sort of sell ads to. And Cardlytics, for the first, decade of their existence, was able to basically just add new users over and over and over again. So they'd land Bank of America, and then a few years later they'd land Wells, and a few years later they'd land JP Morgan, a few years later they'd land US Bank. So it's a really great way to say, like, we don't even need to make any product improvements. We're just increasing our user base by like 20% a year. So our revenue is going to grow 20 something percent a year. So that's kind of how it went historically. And after they landed Chase, you sort of enter 2021 and there's not any big banks really to add left. Like, it's pretty much Amex is only potential partner that you could really get. And at the time, they've been talking to Amex on and off for a while, and Amex just wasn't super interested. So they ran into a place where they needed to improve the product. And this is a company where the founders, they had both been bank people. They were working on like loyalty at, I think it was PNC prior to founding Cardlytics. So they were really good at, getting those relationships with banks, getting into the ecosystem, but they were really bad at product. So as, user growth stagnated, you also started to see pretty significant revenue stagnation. And unfortunately for them, that also overlapped with, the post-pandemic sort of withdrawals, where it's tough when you had, explosive revenue growth and then suddenly it stalls out just because of, the mix of macroeconomic factors, as well as, poor product decisions. So they weren't making a lot of progress. Like, they were promising things that just weren't happening because it's pretty slow to do, software engineering with a bank partner. And also there was some very, very, very value destructive M&A activity. So it was a convert where they had to pay out, a bit over 100 million. And at the time, the stock price was like $100. So they're like, we'll face a couple percent, few percent dilution. It's not a huge deal. Like, we'll just purchase this thing. It'll work out for the business, blah, blah, blah. Unfortunate part is there's no collar. So when the stock goes from $130 to $3, you start to face this, sort of death spiral where you have to issue, 20% of your market cap in equity, as well as pay out like 80% of your cash balance, which isn't great when you're also facing, a macroeconomic slowdown and poor COVID comps. So it was sort of a perfect storm of things going wrong for them that caused the significant stock drawdown. And because
Yeah, I
of the
think it's
dilution, it's, it's not like they're going to get back to the same place they were before. So it is significantly diluted from where it was prior to 2021, which is unfortunate. But if you own it after, it's not as big of a deal.
right. Yeah. If you didn't experience the 95% drawdown, that's always a good thing. And, it can be, we did talk about this before the show, what can be attractive with these type of situations is when something goes down so much over multiple years, so many people hate it, disregard it for no reason. And especially if they've been hurt by it, they have the battle wounds that maybe a fresh face does not. Now, we're going to talk about the recent stuff, in your write-ups that you've done 2 recently that I thought were quite good. We're going to talk about the difference between billings, revenue, and contribution. We're going to talk about the Amex partnership along with the Chase relationship and maybe the gives and takes there and the new management team. But I want to maybe confirm for the audience here, because it's a business that isn't as intuitive, but once they've probably interacted with the product, they'll understand it. So essentially, correct me if I'm wrong, they work with a bank, say Bank of America, and then they also work with a bunch of retailers like, for example, a Lululemon, who may or may not be a partner. They make promotions for Lululemon, put them into the Bank of America app, and Lululemon wants to work with them to get a new customer from Bank of America. Bank of America wants more spending on their cards, and Cardlytics works as a middleman there. Is that correct? And is that their entire business model today, or is there anything else on top of that?
Yeah, so that's sort of the basic idea. So if you have Chase, Bank of America, Wells, and you go into your bank website or bank app, and you scroll down to your Chase offers or your Bank of America deals, it's always bank branded. So Cardlytics doesn't have any branding within the bank app, but those offers are powered by Cardlytics. So what Cardlytics does is they go find advertisers, so your Lululemon, your Starbucks, your Chipotle, whatever, and they say, we're going to give offers to bank customers in the bank app. The way we do it is we do like percent cash back. So if I'm Lululemon, I want to give customers 10% cash back. Then when that customer, they go buy something from lululemon.com, or they go to the Lululemon store and they buy something, that transaction will show up in their bank statement, and the bank will give them that 10% cash back, and that's funded by the advertiser. And then everybody takes a cut of that. So that's the majority of the business. And then they're also working, this is sort of newer, and there was a post by them and the CEO on LinkedIn yesterday about Ripple and Bridge. So what they're doing with those two is they're going to retailers and grocery stores, and they're asking them to basically give them their point of sale data, and they try to combine the point of sale data with some of their transaction insights and give those retailers, a better perspective of like how customer spend is at their stores, and like if it's shifting to competitors, so they can do a little bit of that analytics with some of that additional data. And that's something they've been trying to move into more, because obviously if you can see every bank transaction for hundreds of millions of cardholders in the US, it's pretty valuable data. So they've been trying to monetize that a little bit more. And that's something that they're working to this year.
Yeah, and they do have a surprising amount of users. I think 186 million. I read in your
Yeah,
report
so
there.
total, it's a little complicated, right? Because there's, total cards in the US, which is like people are going to have numerous cards. They see hundreds of millions of cards. And then obviously you're going to have people that have numerous bank accounts. So they've changed their MAU disclosures, I think a couple quarters ago, where they were not deduplicating it as well. Because if you're at Bank of America and Chase, like they don't know your name and everything. They just see your transaction data. So it's a little hard to tell like who's a unique user. And then it can also be hard to tell like if I have two cards at the same institution, like all that kind of stuff. And like they only look at people that use the app or engage digitally on the website. So there's some card holders that they don't do either of those. So the MAU number, it's, cutting out a lot. And it's also, that MAU number is sort of like the theoretical amount of people that can view the ads. It's not like the actual number of people clicking into the ads and activating ads each quarter. So it's a little complicated on the user side, which can make it a bit tough.
Makes sense. Now, if I'm a listener, first time learning about this company, I want to know the unit economics. And I think this next question kind of leads into that, where there's this discrepancy and confusion. I think a lot of people that kind of look at the headline numbers of billings, revenue, and what they call contribution. What caused, or what are those, and what caused the divergence last quarter that you think maybe presents an opportunity for investors?
Sure thing. So the main thing is billings. So billings, that's just the number of dollars that an advertiser uses to fund a campaign. So if I'm Lululemon and I want to give you $5 million and you're going to try and generate, some return on ad spend for me with that $5 million. So they'll hand Cardlytics $5 million. And then with that $5 million, that gets split three ways. So some of it will go to the consumer. So that's going to be the cash back. So if there's 5% cash back, then some guy spends $100 on like leggings for his girlfriend, then he gets $15. It's 15 out of that 5 million. Then the bank and Cardlytics, they also need a share. So the bank share, that's called the partner incentive or the partner share. And that, is going to be roughly equal historically to the amount that was given to that guy who just purchased leggings. So guy gets $15, bank gets $15. Cardlytics, they get their own share. That's called adjusted contribution. So they would get, again, historically, roughly $15. So in total, it's roughly a 33 split historically. It moves up and down a little bit of billings for each of those buckets between consumer, bank, and Cardlytics. Revenue is defined as the bank share plus the Cardlytics share. So it's just billings, then you take out however much goes to the guy that just bought something. So that can cause a little bit of confusion, right? Because if a bank decides to take less money and Cardlytics takes even, let's say, the same money, revenue goes down, but Cardlytics is still making the same money. So like that portion of revenue that goes to the bank that was never Cardlytics in the first place. Like they have contracts with banks that sort of like stipulate how that partner share is determined. So what happened in the most recent quarter is banks, they've been taking a lower partner share over time. So like, we'll get to this later, I assume, but Cardlytics just signed Amex. And part of that Amex contract is Amex wants to take a 0% revenue share. So the idea, I think, is that if you're a bank and you take no revenue share, then your offers are much better than any other banks, right? Because if historically you're taking 33%, and if you give most of that back to the consumer, then your offers are like twice as good as any other bank, right? So we saw Chase last year, they reduced their partner share. And it seems to be the trend in general that partner share is going down. So that's the money going to the banks. Whereas the money going to Cardlytics, that's been up as a percentage of billings or flat depending on like the institution. So you can create this dynamic where, let's say you have $100 million in billings and it used to be 33, 33, 33. Now it might be like 35% Cardlytics and like 28% for a bank. And then you're only getting to like 63% instead of 66%. So revenue would be down by that 3% difference, but obviously Cardlytics would be up because they'd be at 35% instead of 33%. So they make more dollars. It's just the headline number is going to look worse.
So, from the bank's perspective, do you think they look at this more as a customer retention, customer attraction tool as opposed to like a revenue generator?
Yeah, absolutely. So Cardlytics, they don't share a ton of data on this, but every now and then they'll give you a little bit of a smidgen just because banks they're pretty private. They don't want like, you know, a lot of sharing of their metrics. And like right now, Chase is the only bank that's like fully on the new UI and everything. So if they give any like big info on that, then they're basically giving info on Chase, which they want to avoid. But every now and then they'll say that like it increases like spend for cardholders that interact with their program by like, 12% or something versus people who don't interact. Or like card churn might be like a couple percent lower. So if you look at it from a bank perspective, right, like let's assume your cardholder churn is like 96%, and then with Cardlytics it's like 98% retention. Then that extra like 2% retention, that can be saving you like, thousands of dollars on each of those customers that doesn't churn. And at scale, that can be worth like hundreds of millions or billions of dollars to a bank. So it can be worth a lot more than the advertising dollars that they would get. And it can also, it's helpful as well from like a merchant relationship perspective, right? Where it's like, hey, like if I'm Chase and I really, really, really want to keep, some merchant taking my cards and I want to have some partnership with them, I can be like, hey, you want to run like cashback offers through Cardlytics, right? Like we're handling your business accounts, blah, blah, blah. Like maybe you want to run some cashback offers through our platform. So there can be a lot of value generated for banks that isn't just the amount of dollars that they get.
Okay, you mentioned American Express. This is a new, I would say, the details of the deal is just an 8K, I believe, at this point, and it was 3 weeks ago. There's still, it's up in the air of what's actually going to happen over the next few years, I would think, from a shareholder perspective. But the question I have for that is, why would an American Express want to work with Cardlytics? Because if you look at, say, the American Express app today or some other ones out there, they already do some of this on their own. Do Chase and Amex, I think they're the two biggest players. Do they need Cardlytics? Like what stops them from fully vertically integrating these solutions?
Yeah, so I think there's a couple things there. First off, I'd just say that with Amex, this whole offers in the bank app sounds a lot easier than it is. So like you have to be ingesting, like a ton of data every single day. So you're looking at like millions and millions, billions of transactions each day. And those aren't always pretty, right? So like maybe Starbucks accidentally set up their point of sale system and it's like Starbuck instead of Starbucks, right? Like they just misspelled something. So you have to clean that up and then you have to like analyze it all. And then you have to serve it to users, and you have to like find who the most relevant users are, because like there's a limited budget. So you can't just send every offer out to every customer and be like, well, we'll just see how many people redeem. Because if you do that, then you have to eat the difference when too many people redeem, or you disappoint an advertiser when too few people redeem. So it's a very intensive process on the data analysis side. Then also on the tech side, because you're working with banks. So there's very high privacy concerns. Like there's sort of the famous like thing in the ad world where like Target like gave an ad to someone who was like just got engaged about like pregnancy related ads, right? And the person's like, oh, that's weird. How do you know I just got engaged? Like people can be kind of sensitive, and that's doubly true for banks as well as data security. So it's very hard. And Amex, from what I have heard from people who work at Amex, is that they consider Cardlytics to sort of be the best of the best technology-wise, which makes sense, right? Because they're working with a bunch of different banks. So I think what Amex is doing is Amex is looking to do an entire overhaul of their offers program. So Amex, as well as Chase, I think they've realized that with interchange fee pressure, a really great way to make up for that is to just go to advertisers and be like, hey, why don't you fund some of these cashback rewards to consumers? We want to have more interactions with our consumers because there's so many benefits for us. You want, consumer spend. We are a platform with hundreds of millions of users with a bunch of data that we haven't monetized very well historically. And so Amex, in that sort of exploration of redoing their whole offer platform, they've been talking to Cardlytics sort of on and off for like years now, right? And I think Cardlytics, it's hard to say exactly why now that's happening, but one potential reason is just all the progress that's been made at Chase. So like Chase offers, the redemptions there, it was up something like 30% year over year with Cardlytics. So that's a pretty big deal when Cardlytics is driving, like according to Chase's last investor day, like Chase offers is driving over $8 billion in transactions each year. And if you can sort of continue to scale that and get up in the tens of billions of dollars, that's a great way for banks to sort of build out that relationship with consumers. And I think that's sort of a trend you've seen in a lot of places. Like you have Amazon, where they're trying to go more direct with ads. You have retailers like Walmart partnered with Trade Desk to do, their sort of retail ad network. So I think all of these old legacy businesses are really realizing that they can monetize their consumer relationships pretty well. And I think the banks are another part of that. And with Cardlytics, right, there's not really any alternatives to Cardlytics competitively. So like Chase, they acquired Cardlytics' like only semi-real competitor Fig. That was a little bit less than 2 years ago. And Fig, at the time, they had like limited relationships with smaller banks and like a trial run with Bank of America that didn't go very well. So they were never really, Cardlytics was never really at risk of being replaced by another vendor. Obviously, there's concerns of if the banks will replace Cardlytics themselves. And I think to that end, there's sort of two ways to view it. So like Amex, they just signed Cardlytics, right? So Amex, they want to, drastically grow their offer program. They say, hey, the Cardlytics tech is better. Let's go with Cardlytics. And I think another part of it too is that they don't have to have like some giant sales team going around to a bunch of different vendors and being like, hey, let's try and do some offers. And then the vendors may be like, wait, you're Amex. I hate your fees. Why are you charging me like 5% or something? Like maybe we can do some offers, but give me a little bit back on interchange fees. So that's something that's happened historically when these banks have like gone and tried to have that conversation directly. And it's also just harder to get scale, right? So Cardlytics, they can sell into every bank. If you try and do it directly as Amex or Chase, you're only selling into your bank. So like I know advertisers who advertise with Cardlytics, and if they like, there's not a situation in which they can go direct to a bank right now to like replace Cardlytics, but like in theory, even if they could, it's like, why would I do that? Because I would be cutting like my space that I can advertise to by like 2/3 if I just go to Chase or if I just go to Amex. And if you go to like a smaller bank than that, you're cutting it even more. So it's like you would have to give me a pretty sweetheart deal for me to maintain that exclusivity. So like Amex, right? They have an exclusive relationship with Uber. So like Chase, they don't have any Uber offers. Like they're partnered with Lyft, and obviously Uber has done quite a bit better than Lyft. So I'm sure they're a little bit salty about that. And part of that is that Amex is funding those Uber offers. Like they aren't saying, "Hey, Uber, give us a bunch of money." Amex is saying, like, we're going to lay out some money because we want to compete with Chase and give our cardholders more benefits. So I think Cardlytics plays nicely into that, where they can give all of these banks a lot of different offers scale to a lot of different offers. The tech is very nice, and it really plays into sort of strategically where they're moving. And the banks, like I imagine the way it works is if you're Amex, you probably want to maintain that Uber relationship. So you're going to be like, I have a few vendors that I really want to be exclusive, and I'll have Cardlytics provide like the bulk of my offers, like the daily spends, like your quick serve restaurants, your constant shopping retailers like a Walmart or a Costco or something like that, right? Because I don't want to go manage that relationship. That level of spend is way too high for me to fund that myself as an Amex or a Chase. And Cardlytics, we can just let them do a bunch of tech, and we can work on our own tech that would augment that, because it has been a thing where banks want some competitive differentiation, but they can have that in tandem with having Cardlytics and just have Cardlytics sort of be the baseline of their offer program. And it does seem like the offer program is a pretty huge trend in banks currently.
Okay, and if I'm looking at it, say, as you explained from American Express's perspective, they may have that long-standing relationship with, say, a Delta, a Marriott, or an Uber. They don't need it. They want to make that exclusive almost, and they don't want to have that go through Cardlytics. But if McDonald's or some fast food chain, they have, I don't know, a new promo, a new menu item, and they want to promote it for 2 weeks, they'd rather work through Cardlytics where that can go blast out to everyone. Amex doesn't really see that as its competitive differentiation, and that's where they have that symbiotic relationship. Is that what you think this partnership is driving at? And I will say for the listeners, I do follow American Express, and I think they just said they're revamping their platinum card this year, or that's what their timeline is, somewhere around this year. So I think maybe this announcement could be related to that as well.
Yeah. So that's pretty much what it is you have those couple key relationships. And like if you're McDonald's launching a new product, right, you probably want as much sort of gain as quickly as possible. So you want that scale. So like to put some numbers to it, the Amex platform, I think, does a little bit over 200 million in billings per year. Cardlytics does around 400-ish, and Chase is about half of that. So Amex and Chase are pretty much the same size. So if you add in Amex to the Cardlytics business, it'd be them at 200 million, Chase at 200 million, and then all the other banks at 200 million. So if you go with only one bank, you're only getting a third of the scale, which is fine if you're now a higher end item that like your customer base is pretty much all Amex cards. Like, who cares anyways, So like if you're high-end watch seller or something, right? Like a lot of your customers probably have Amex, so you can just do that Amex offer, and it's a little bit better brand fit, right? Where you have that luxury instead of like, why am I going to my Amex card to buy McDonald's?
Okay, let's talk financials a bit here. The so they just looking kind of a cursory view here, operating income, free cash flow, it's been negative every year since 2015. Eventually this has to turn to the other side. Why do you think this will happen? And maybe do you have any sort of idea on when this could happen?
Yeah, so there's a sort of the simple answer and the long answer. The simple answer, right, is that this is a fixed cost business. So like think of the incremental cost to serve someone an ad via AWS. It's like a fraction of a cent. Like you're just sending an API request real quick. So any additional scale you get sort of drops pretty much fully to the bottom line. The only problem with that, of course, is if you are a subscale business and you have to build out this giant data science team and this big software team to work with banks, and you have to build out your sales team. When you don't have scale and you're ramping that, you're going to lose a lot of money. So I think that is sort of what happened historically. And historically, the growth was there that people were like, you're losing money, but you're growing a ton. So this is pretty worthwhile. And that story only sort of breaks when revenue starts to decline. And that's kind of what happened in late 2021 and 2022, where it's like your revenue's falling, your expenses are pretty flat. You were doing a lot of M&A activity, but the math just ain't mathing. So I think that's what they worked on a lot in 2023. So they cut out some costs of the business because, it's at that point they had pretty much built out the platform. It's just like getting it into bank hands and growing it. So they're able to cut out a decent chunk of costs, and they're pretty much free cash flow break even currently. So like next year, they'll probably, like, if we exclude any benefits, like they're just guiding to like 10 to 12% growth. If they grow that, they're probably like net income break even on a GAAP basis. So that's with, your stock-based comp, blah, blah, blah. And also it's one of those cases where it's like you had some terrible M&A activity. You have to write that down. Your D&A looks absolutely insane. So your GAAP net income looks horrible, but it's like, really all you did was you lit some cash on fire. It doesn't mean your operations are actually like, falling off a cliff. So it's, in theory, they can get back to growing, and they've already sort of built out everything on the cost side, and everything falls to the bottom line. So it should be a lot easier for them to make money going forward. And in the worst case, they're pretty much break even currently.
Okay, so you mentioned lighting money on fire. They they have put in a new management team here. It seems. Is this? I guess could you give some context on maybe who they are, any sort of background you think is relevant, and then do you trust them?
Yeah. So there's like the new CEO, Kareem. He was added just like 18 months ago or so. But we can go back even further than that. So they replaced their chief product officer. I think it was like 6 months prior to replacing Kareem, because I think what they realized was, if you sort of go through all the old earnings calls and disclosures, they were promising a lot of stuff with product that just wasn't happening. And previous management, they made a lot of bad decisions, but I think one of their good decisions was they realized they needed to really revamp the product team. So it started, and I think it was either late 2021 or early 22. They basically laid off a bunch of like the data science team because they're doing things very manually, and they were like, okay, we need to make this a modern, data-enabled advertising business. So that's his name's Peter Chan. He's the CTO, and they got a new CPO, like Jose Singer. So those two guys, they're from Yahoo. Yahoo, obviously, not the best business in the world, but I think technologically is sort of building out, block and tackle advertising stack is not the hardest thing in the world. It's just sort of doing it in a bank environment that can be difficult. And I think they're just a little bit more aware of what they needed to do technologically compared to previous management, which had no tech know-how. The example I was given speaking to engineers previously, it's like they found a oil field, and instead of building, oil wells and drills, they built a bunch of cups, and they handed them to some data scientists and told the data scientists to go pick up cups of oil and bring it back. So that's a transformation that's been underway for a while. And then in comes Kareem. So Kareem, he is the new CEO, and he used to be at Stripe, Google. He was doing like wallet offers at Google, and then obviously Stripe, big payment business, lots of tech related to banks, blah, blah, blah. So it's a pretty good overlap with his experience. And he was building out, sort of the Google advertising business in the APAC region for a while. So he has experience like scaling an advertising business. So in theory, that's a pretty good hire. And obviously with Stripe, you would hope he has a lot more tech know-how, considering he's managing tech teams than the previous management. And since Kareem's joined, we've gotten the new UI launch at Chase. So like that was in development prior to his tenure, but we actually got it, out the door under his tenure. And then it's a little bit hard because last year he had to put out some financial fires instead of really focusing on product, just because, the way macro was and the way the business had sort of been set up financially, which wasn't his fault. So I think it's a little hard to blame him for what was happening to the stock in that interim. And this year, I think they're really focusing on executing on products. So it's a little bit of we'll see how it goes, because, they've said that they want to get a lot more analytics in the hands of advertisers and like dashboards and really make it like a modern advertising company. And that's something that they've started to pilot this year. And there's no banks in their way. So like historically, Cardlytics is a business where they'd like guide to some tech improvement at a bank, and it always takes 6 to 12 months extra just because like it's a bank, and banks operate on their own timelines. And sometimes even if something's planned, it's like, oh, we're a bank, so we have to kick it to next quarter. So this is the first time they're really doing a big tech overhaul on their own terms. And it seems like, in theory, I think that's a really good idea. So like previous management, they're working on like self-serve for small businesses and small advertisers. And like, I don't think that's really a good idea, because like Cardlytics, it's not at the point where you can really be self-sufficient. Like it's very white glove still. So that's what they've been trying to improve. So if you launch self-serve, but the business is still white glove, then you just have a self-serve platform that is pretty worthless. So it didn't make a whole lot of sense to me under previous management what they were doing with product there and like the prioritization, whereas it really seems like Kareem, Peter, and Jose, like their eyes on the ball quite a bit more with product, and they're doing things in the right order. So they're building out analytics. And on the last earnings call, they're asked about self-serve, because that's been something people have been asking about for a while. And it's like, they said basically, like, yeah, that's still on our radar, but like we have our more pressing issues. And so I think they've done a great job at prioritizing, and we'll sort of see how that plays out in practice this year. But it does seem like they have a much better idea of how to handle product, and they have not acquired anything for $500 million that they had to write down by 90-something% yet. So that's also a plus.
That's a good
sign.
hurdle. Yeah. That's
Low bar.
positive. Yeah, from this existing management team. I will say, as we're recording here, Ryan may have to hop off for any of the people that are watching on video, so he has to go to work. He does have an important job he has to get to, so that might happen. But we're gonna basically close out here with talking about, a fun question: what's the upside here if Cardlytics goes right? And then there are some Twitter follow-ups that I want to put in as well, just for the people that ask those specific questions. We want to make sure we hit them. So sounds like we could be at a potential inflection point. Obviously, it's not guaranteed to happen. I just checked their, say, EV to gross profit, and it's below 5. So there's, the expectations here, if they can, with that fixed cost base, are pretty low, right? I mean, it seems like people are expecting it to really go nowhere for a while here, or just for the indefinite future. So at a stock price below $10, just below $10 as we're recording this, what's the upside here if things go right? And what do you think the downside is here? Is the balance sheet risky? Just upside and downside as we close things out.
I guess a couple things.
FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. And beyond that, they have company-specific segment and KPI data on more than 1,500 stocks. So to give some examples here, you want to see Netflix's average revenue per member over the last 10 years? They've got it. You like to track YouTube's advertising revenue? They've got that too. If you want to see Celsius's revenue that comes from Costco, how much of their revenue comes from Costco, they also have that. So the breadth of FinChat segment and KPI data truly is one of a kind. I use FinChat every day to track and manage all my investments. I also use it to discover new investments. And if you want to get 15% off any paid plan, go to finchat.io/chitchat. That's finchat.io/chitchat to get 15% off any paid plan. The link will also be in our show notes. Earlier in the show, you heard us talk about the investing platform, public.com. That's where you can trade options with no commissions or per contract fees, and you get a rebate of up to 18 cents per contract. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. U.S. members only.
I guess a couple things. So catalyst-wise, like they aren't going to face, anything hugely transformational until Amex launch. So Amex launch, I'm guessing that's late Q4, maybe initial testing this year, maybe early Q1 with a full launch by Q1 or Q2 of next year. So that's, I think, in theory, right, I mentioned earlier, billings is like 200 million at Amex versus like 400 million overall at Cardlytics. We don't know how much of that is going to end up at Cardlytics. We don't know like how beneficial that cross-sell is. Like maybe they can get Amex at 300 million, no idea. So that's something that is very hard to assign a value to, but in theory, right, that could be north of 50% billings growth sometime in 2025. Excluding that, this is a business that is, I guess also as a disclaimer, there's a very, very wide range of outcomes, right? Like if you just look at their Q2 guide, you could drive a truck through it. Like it's somewhere from like 17% growth to 7% growth in terms of billings, which implies quite a few different things, right? So I think the core things to look at are going to be billings and adjusted contribution and how those sort of shake up over the next, 24 months. But if this is a company that they can grow sort of at that midpoint, at that like 10 to 12% range, they're doing somewhere around GAAP break even next year, and you're adding like $20 million of earnings power roughly if you're growing 10%. So you do that for a couple of years, you're in the 50 to 60 million range by like 2028. And I think the enterprise value is, changes quite a bit.
I think I saw, unless the
So
aggregators are wrong, a bit over 500 million.
yeah, be close. Yeah, a bit over 500 million. And so it'd be like 10 times earnings in like 3 to 4 years. So they can just sort of execute at a pretty basic level. And Amex isn't like, that's sort of like excluding Amex. And then, so I think that creates a pretty decent little margin of safety, I guess, where if the business just sort of chugs along and you don't really believe that much in Amex, like you're probably getting a slightly market-beating return from a single-digit stock price, assuming there's no like hiccups in the business, which is not guaranteed with them. On the plus side, if Amex is, adding 50% to billings and they really execute well with like this Advertiser analytics platform, and like they're coming in at the high end of billings in Q2 at like 17%, you start getting to a business where you could be growing 30 to 50% billings year over year for quite a few years. Like that's, if you look back a few years when they added JP Morgan Chase, like they were getting quarters where they were growing billings by upwards of 50%. And Amex is pretty similar in size to that. So it really just depends on what that relationship looks like. But this is a company where you double billings, like you're at 800 million and suddenly your gross profits at 400 million. Like you're talking hundreds of millions of dollars in incremental earnings just because the unit economics of a fixed cost business model with no marginal cost. And that can get you to a stock price that is 5, 10, 15, 20 times higher than it is currently. It just kind of depends on how they can execute there, as well as what it ends up looking like with Amex. So it seems to me like that's sort of the skew is in that positive direction, just because we see JP Diamond talking about how offers are a big deal. We see Chase really investing heavily in the platform, and Chase is growing 30% year over year with Cardlytics. So like the overall Cardlytics growth rate is lower because like Bank of America and Wells and some of those older banks, they aren't as technologically advanced as Chase. And for some reason, Chase really sees what's happening here and they think they want to invest a lot in offers. And it seems like Amex does as well. But Bank of America and Wells, it doesn't seem like as much of a big deal. So as more the business becomes that Amex Chase that really want to invest in offers, you can get like pretty sudden accelerations in billings growth, which would be hugely beneficial. To the downside, they have 200 million in convertible debt. It's due in 2029, I believe. That isn't really a huge deal because they would have, 4 years, 5 years to sort of figure that out. And 200 million, obviously they can refinance it. They refinanced it this year. It's hard for the stock, I think, to be drastically worse than it is currently, just because you're roughly break even. You have cash for 5 years. You have been growing even with like a rather mediocre product and historically mediocre management team. So even if you just sort of chug along and things aren't growing that great, like I don't think it's something that has, significant downside potential. It's not like there's bankruptcy potentially around the corner, which was sort of the whole scare in 2022 and 2023.
All right. That's, I think, a great sum up of the bull case and some of the downsides there and what could go right. There are a few good Twitter questions I think can help with some follow-ups that any people have. First one I think is interesting. A couple people asked about similar things on this is targeting and measurement, where Cardlytics is, as they talk about, supposed to be better than almost all other ad platforms. So return on ad spend should be, similarly better. Why do you think advertisers maybe aren't appreciating these advantages at the moment?
Sure thing. So part of the way Cardlytics works, right, is they will show ads to like some portion of their users and then not show ads to another portion. So you have your test group and your control group, pretty basic. And what they do is they try and measure incrementality through those groups. So it's like we have 1,000 people, we show them offers, 1,000 people we don't show them offers, and 70% of the people with offers buy, 50% of the people without offers buy, then we sort of got you that incremental 200 transactions. And that's how they're going to measure their return on ad spend. So from what I've read from advertisers, from what I've talked to advertisers about, blah, 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 the return on ad spend at Cardlytics is obviously really good because you can always tie the ad to the transaction because you have that control group and that test group. You know for a fact, like the people with the ad purchase more, and you have sufficient scale that isn't really in question. Like we're talking N equals 10,000, 100,000, million. So the only issue is that it's not really a high scale platform or a high tech platform. So like if I have a meta campaign, I can go into a meta campaign. I can dump $10 million into that campaign. I can see it get consumed in real time. I can see that in my numbers because it's meta. Everyone uses meta. Like 80, 90% of adults in the US have some kind of meta account. We're talking ARPU 100 plus. Like it's really easy to feel the meta advertising. So you can be like, okay, I can see what's happening. I have my own internal attribution model as an advertiser. I'm like, okay, like this link was referred by Meta. Whereas with Cardlytics, like this is a business that historically they've had to grow scale. So like you'll read on Tegus or something, if you have that, advertisers where their concern is like, we tried Cardlytics in 2018 and it just wasn't really there for us. And we couldn't feel it in our numbers and we didn't know if we should believe them on the incrementality because like they're doing like 2 million incremental dollars of spend. So it's like great returns in theory on that 2 million, but you can't feel it. And then Cardlytics just tells you a number and you're like, I don't know if that's true because I can't feel it and I can't really see it in a dashboard or anything like that. So I think that's something where they've been working on that quite a bit. So it's that dashboard I mentioned earlier. They're trying to roll that out this year. So as an advertiser, you have a bit more visibility into how a campaign's going. You aren't sort of, getting a report on how a campaign went, like on a 90-day delay. So they've been trying to fix that. And then also, like, they've added more scale. So they've added Chase. Chase is really leaning in. They've added Amex soon. Amex seems to be really leaning into offers. So that sort of drastically increases the scale at which you can sell ads. Because when we go from, 2 or 3 million in spend, 6 to 10 plus million, it's a lot more common to see that in your numbers. So like the advertiser experience in Cardlytics has been a little bit segmented where you have advertisers like Panera or something where they're big, they do a lot of advertising, they're pretty competent, they've put a lot of work into verifying Cardlytics and they're pretty happy with it. And then you have advertisers where it's like, I just wanted to plug this into my model. I couldn't plug it into my model. I couldn't see it. I couldn't feel it. Like, it's not a huge deal to me. So that's something that they need to address, and it seems like they're working to address.
Yeah, and just for reference, people are aware that both Chase and Amex are large businesses, but that's combined trillions in annual payment volume. So as you can tell, for a merchant advertiser, that can be quite valuable. There's two more I have here that I think are interesting as these Twitter follow-ups. First one is related to PayPal, which I guess we haven't talked about. Maybe correct me if this Twitter user is wrong, but they say PayPal is launching its own ad business. Any chance for Cardlytics to work with PayPal? And I've also seen them trying to add more banking solutions on Venmo, which PayPal owns.
So Cardlytics kind of works with PayPal. So they acquired a company called Dosh, and Dosh, it's basically just like a little loyalty app you get on your phone. You open it up, it has like third-party rewards, basically like an aggregator of that kind of stuff, and they put it in a pretty UI. So Venmo was working with Dosh. So Venmo had offers powered by Dosh, ended up being powered by Cardlytics. I think the thing is that those offers, sort of by nature of that platform, can't be as good as bank offers, just because the data that a bank has and the data that PayPal have are going to be quite different. And also just because like the format, right? Like PayPal is PayPal and the banks are the banks. So it's like what you make for one bank is generally pretty applicable to all the banks, just in terms of like how you format offers and how, sort of the pipes work. And it can be hard to justify supporting that for just PayPal, especially if PayPal is like completely different data that you have to work with. So I think it's not a huge deal to Cardlytics what PayPal ends up doing with payments, just because I think PayPal is sort of at a natural disadvantage to banks in regards to like payment data. And also PayPal isn't necessarily at a scale where it's super relevant for Cardlytics. Like the Venmo Dosh partnership is not something that they've invested a lot in, and they haven't invested a lot in neobanks either. I know that was a pretty big focus in like 2021 hype wise, but it just hasn't really panned out that way. And I think part of it is the engineering reason, where it's like I would rather just focus on my like trillions of spend I already have. And part of that is just much harder to work with those types of platforms that aren't like as stock standard as what they're used to.
All right, last one here. I think this one's interesting. I actually didn't even know that they had this business going in. With any listener should probably research this for any sort of upside stuff as well. It's the Bridge platform. A few people asked about this. They said, essentially, what's in it for the retailers? Why do they want to give them their point of sale data to Cardlytics? Like, what can they provide to them? Can they give them a similar return on ad spend as they would on these digital platforms?
So I think with Cardlytics, one thing to think about with the return on ad spend is that historically, right, the way it works is you sort of just get cash back, like a flat percentage or flat amounts at some advertiser. So like if McDonald's wants to give me 10% cash back, then regardless of what I buy, they're giving 10% cash back. Same with Walmart. So if Walmart does 10% cash back and I go buy groceries, is that really win-win for Walmart when grocery margins are probably in the single digits, right? So what Bridge can do is Bridge can get a lot more granular with what exactly is being purchased. So instead of just seeing like, because if you think about Cardlytics the way it's engineered, like if you go look at your bank statement and you make a transaction, it'll just say like Starbucks, blah, blah, blah. It doesn't say like every item you purchased. What Bridge wants to do is they want to say, give us your payment data, and then we can see sort of granularly what makes up that check. So if I'm at Walmart, they'll see, oh, you spent $50 on groceries and it was like lettuce, meat, chips, blah, 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 blah. Then you also spent like $500 on a TV. And maybe our TV margins are a lot higher. So historically, we don't want to give you 10% cash back because you'll just go buy groceries with it. But maybe we're like, hey, we'll give you 10% cash back if you come buy a TV from us. And so it opens up ads to Walmart in a lot more of an interesting way. So it's primarily retailers. And you can also partner with CPGs there, right? Because you can say like, okay, is it just a Walmart check? Like that's not really interesting. But if it's say Crest toothpaste at Walmart, that's maybe a lot more interesting, where Walmart can work with Crest and they can be like, okay, we want to put an ad through the platform, and now they can. So that sort of entire area of budgets was off limits previously, and obviously CPGs spend a ton of money on advertising. So Bridge is really beneficial in that way, and opening up those new relationships. Obviously, Bridge, it's sort of been a work in progress on the tech side, and it's really sort of coming into its own this year. And those relationships are new, so it's going to take a while to build them out. So it's not like that's going to be a drastic increase in near-term numbers. They've done a couple pilots. Another benefit of Bridge, though, is for your existing clients. Like, if you are that Panera Bread or you are that Starbucks, you're like, I want you to come in and buy pastries because nobody buys a pastry at Starbucks. They all buy coffee, and we have way too many pastries. Like, please buy our pastries. So they can give you like, here's 5% cash back and an extra $1 if you buy a pastry or something like that, right? So it makes the ads a lot more customizable for advertisers, which all else equal should drastically increase, return on ad spend and also the amount of money that Cardlytics would make.
All right. Well, thank you for joining us today. Let's say as we close out here, anything else you want to talk about Cardlytics for any listeners who want to learn more? Anything that you think they should take away from this episode? And where can investors find more of your work? And we'll make sure to include those links in the show notes for any listeners to go check out.
Yeah, I think with Cardlytics, really it's just, again, as a disclaimer, the stuff I do is generally pretty high vol. Like, I've sat on 90% drawdowns that turn into 1,000% upsides. So, do what you're comfortable with. If you DM me that you lost money, it's like, well, happens. It's sort of the name of the game. And if you want to follow more of my work, I've done stuff Cardlytics, Carvana, Blend Labs, doing a lot more, mostly small caps. If it's leveraged, if it's doing something transformational, hopefully I can find interesting stuff. I'm on Twitter at IndraStocks, and Substack is also IndraStocks. So it was great being here. I appreciate it, guys, and hopefully Cardlytics works out as well as some of the other ones have worked out.
Yeah, I hope so as well. Thank you for joining us. I learned a lot, so I think any listeners will as well. Let me hit the disclosure and we can get out of here. We are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, for listening to this episode, and we'll see you next time.